it's not got lots of numbers on, it's more sort of graphical than anything else. But before I show you that, it's a way of viewing potentially investments that you already have or potentially ones that you might look at in the future. Some of those are different categories, some of which Graham's touched on, some of them might be in different countries. So given I'm going to be talking about that, I know a couple of you in the room have already invested abroad, but just a show of hands, how many of the rest of you have invested abroad before in property? Well, there's a few of you, okay. And is anybody else considering in the near future investing in property abroad? Okay, okay, let's see if this is going to work. Aha, right. So let me explain the chart. So this is how to thrive through growth. What I've tried to do is show a number of different dimensions on a single chart. So on the y-axis, I have got potential capital growth going from low to high. On the x-axis, I've got yield going from low to high. I have a series of blobs, or whatever you want to call them, data points on there. Now, the colour of the circle shows the red or versions thereof are which categories of property have been affected by tax changes or are about to be affected by imminent changes. The blue ones or versions thereof are the categories that aren't really touched by any tax changes. So you can immediately see which ones are more beneficial from the tax change perspective. Size of circle denominates, roughly speaking, the amount of effort required to manage or invest in that category. Now, there are lots of different variations within that, dependent on whether you're self-managing or whether you're delegating that to an agent to manage for you. So just looking at the traditional centre there, the UK cities in the north, the likes of Birmingham, Manchester, you'd expect sort of some decent yields there and some decent capital growth. Could be talking about 5, 6, 7% plus yields, slightly lower capital growth, as compared with some of the southern cities. I've got London up there just as a comparison and extreme. In the city centre, you could be looking at low yields of 1, 2%. Clearly, there are parts of London where you can get higher yields. If you go into some of the growth areas, might be affected by the Elizabeth Line or various infrastructure improvements. But generally speaking, you'd be expecting lower yields, but potentially higher capital growth. Now, it's a bit of a melting pot in London at the minute. What with the tax changes at the higher end of the market, it's being affected and subdued. Brexit's affecting some of the higher end of the market as well. Some of the overseas investors are a bit wary about investing. I'm sure it will become good. It's still predicted to be one of the best opportunities for capital growth over the next 10 years. But it's just a bit of a mix at the moment. Now, Graham's already mentioned, for those of you who are looking for slightly higher yield, you can push yourself further over the scale there by switching to furnished holiday lets or indeed serviced apartments. Now, the furnished holiday lets have been affected by the tax changes, but the serviced apartments haven't. So you can get higher yields from switching use and how you let those out. HMOs, housing of multiple occupation, they generally tend to give much higher yields, around about 10%, maybe slightly less capital growth than a straight buy-to-let residential, but that is one way of increasing your yields and still benefiting from beneficial tax treatment. The issue with HMOs is that they tend to require an awful lot more effort, a lot more regulation around them, and people tend to specialise in them rather than just flitting in and out. It tends to be a sector that you ought to go into in a big way rather than flitting in and out, because it is quite specialised. Down the bottom here, you can get some quite high income from some property-backed bonds, which Graham's going to talk about a little bit later. And there are some other categories here. Managed properties in France. Now that hinges on a leaseback concept. The leaseback concept exists around the world. I'm, for the purposes of tonight's presentation, going to focus on France because there are some specific examples that I want to give you. The managed property or the leaseback concept on which this hinges is a great way for those people who want to mix a bit of investment with a bit of a holiday home. So those of you that would be interested or might be interested in buying a holiday home, but know realistically you might not use it as much as you'd like to get the maximum benefit from the financial outlay, this is a great way of doing that because you get some income, so a decent yield, and at the same time can use it personally as well. And I'll look at that a little while. And on the hotel side, This is a trend that's come about in the last decade or so, where people are investing in units in hotels and getting the income from the room. That's treated as a commercial property, so you can get decent yields investing in those kind of units, or you can invest in a fraction. If you want a lower entry threshold, you can get fractions of hotel rooms for about 30,000 and get decent yields, 7 or 8% on those. And again, they're in a different category, treated differently for tax purposes. So if I just look at each of those in turn, for those, some of you might be familiar with the leaseback or managed property model, but for those of you who aren't, just a quick overview. As I said, it captures the advantages of, it's treated as a furnished holiday let, but you can also use it as personally and get income. So you invest in the property and own the property, but you enter into a long-term commercial contract with a tourist management company who let out the property on your behalf, get the occupancy up, pay you the rental income. So you also would then be dealing with them if you wanted to book a week or two yourself. So the model is that you buy, you invest, you own the property, but you enter into a long-term agreement, get it let out. So it's a low-hassle concept, but you get some income and you get some personal usage as well. In terms of what it has to offer, this managed property model can offer double tax advantages. So what it means is if you were to buy a property, if you've already got your home here and you were to buy a managed property abroad, you wouldn't be subject to the 3% stamp duty surcharge as you would be if you invested in the UK. Because you're entering into a long-term commercial contract with a management company locally, in France that means that you are get certain tax exemptions. So you would not be liable to pay 20% VAT, so you get a 20% discount automatically because you're entering into a long-term contract. It's also considered a commercial property in France, so that means that it's treated as a company. So the kind of things that you can do in terms of offsetting costs against your income, you can do that in France. And you also benefit from an amortisation calculation, which means that the way that it works, in the first 8 to 10 years you could be paying minimal tax on one of these investments because of the way that your income and expenses are treated as a company as opposed to an individual. So there's lots of advantages there. One way that some people have overcome, you probably will be noting the sterling-euro exchange rate. It's not great at the minute. Some investors are choosing to take out a mortgage in some instances to buy properties like this, simply, even if they don't need to, simply because you can get 20-year mortgages at 2%, and I think they're actually fixed. So that's a way of putting down cash deposit, but then not exposing yourself to the exchange rate currently, but taking out a local mortgage in France and benefiting from long-term low interest rates, significantly lower than we have been used to in the past, and fixing them for a very long period of time. In your packs, there is an example of one of these managed properties. I don't know whether any of you are familiar with Ile de Ré. It's on the Atlantic coast, just off of the coast by La Rochelle in France. It's a beautiful island. It's almost like going back to nature. There are hardly any cars there because it's joined to the mainland by a bridge. It's a toll-paying bridge, so you don't get many cars going over. It's a very low-density built island. It's highly unusual to have an off-plan opportunity like this on such an island because it doesn't exist. Prices on that start from €112,000. Lower yields than some of the other opportunities we've talked about, but 4% yields, and you can get personal usage. So if anybody's interested in that, can come and talk to me about that afterwards. This concept, it's important to note, is not just about holiday homes on the coast and the beach. It also applies to ski properties. So, for example, there are some units remaining in Chamonix. So you can apply the same concept, get similar yields, 4%, slightly higher price point. But again, you know, it's a great way of getting a ski property, because most people would probably only use that a couple of weeks in a year anyway, and covering your costs and getting a bit of income at the same time.
Is the yield after the management charges?
Partly. There will be some netting down of that from the management charges quarter, 0.5%. Some of the costs are taken into account, but not all of them. So it's not quite gross yield, not quite totally net yield. Okay, looking at some of the other options that were on that chart. PBSA, purpose-built student accommodation. Some of you might be familiar with this concept, others might not be, but this is considered a commercial property investment. It's interesting because it has certain advantages in that it weathers economic ups and downs in a way that some other property categories don't. It's seen as an enduring asset class, and the beauty of purpose-built student accommodation is that you've got a captive market. If you choose the right purpose-built student accommodation in the right location, 10 minutes from your campus, you already have an immediate target market and an immediate target audience that's captive. And so it's not unheard of in complexes like this to get 98, 99, 100% occupancy. They really are in demand. We are undersupplied as far as purpose-built student accommodation is concerned. Certainly provides regular cash flow, again, a minimum hassle investment, accessible entry-level pricing. In the past, it has been criticised for being not a particularly liquid investment, in that when you want to sell on, it's not that easy. But we've been finding in the investments that we have, that is now starting to build up a track record of resale, and some of these units are now selling on quite quickly on the resale market as well. But it's certainly a high-yielding proposition, and one that you could consider. For anyone that is interested in that, Savills have recently issued a report on the purpose-built student accommodation market, highlights what a great asset class it is nowadays. They also highlight some of the regional hotspots. One of the places that they talk about is Preston, and in your packs there is an opportunity in Preston, which is some accommodation that services the University of Central Lancashire, UCLAN. This is one of the biggest universities in the country. It's not on the market, so it's off the market at the minute, but it goes live at the end of the year. But if any of you are interested in something that's not yet out there publicly, we are taking interest from individuals. This offers 8% yield, starting at 58,000. So that's an off-plan opportunity which isn't yet live on the market. We also have Ready Built in Sheffield. Again, that's a Russell Group University, so a great opportunity there. And that has got a track record and is already ready built. So for those of you who don't like off-plan opportunities. Hotel units offer lots of similar advantages. Strong yield, can be managed on your behalf. Can offer low entry price points because you can buy in fractions. You can buy a fraction for £30,000. Again, high yielding, 7 or 8%. So something that's worth considering. And because it's commercial, you get the higher CGT, capital gains tax rates. And on the tax position, you get no stamp duty surcharge either. So to bring that all together, and to also look at the individual countries, I've got another chart which is slightly different. It's worth considering investing abroad because there are some tax advantages. So you don't get the charge with the additional 3% stamp duty surcharge from buying additional investment properties. What I've got down here are a number of the key markets in Europe and looked at on a number of different dimensions. The fuller the circle means the higher the country rates in that particular criteria. So if we look at the two first columns, I'm comparing each of the countries on an individual taxation level. So if you look at that, you'll notice that Poland has probably got one of the most beneficial personal income tax rates out of those countries, followed by the likes of UK, Germany and Spain. France has got quite a high level of personal taxation. On a company taxation level, again, Poland is pretty keen on its taxation rates. UK comes after it, and the UK, in fact, will be comparable as of April next year when its income tax rate gets reduced to 19%, so it will be competing on the same corporation tax level as Poland. The other markets follow behind, and again, France has quite a high company taxation level. Now it's worth me mentioning, given the fact that I've also talked about investing in France, that these are taken on the published or official tax rates. So this is how I've produced this chart based on the official tax rates. One of the things that characterises the French taxation system is the amount of exceptions to the taxation rate. So it means that because there are so many different things that you can offset against that headline rate, there are ways of doing things very tax efficiently. And the managed property concept is probably the most tax efficient way of investing in France, because it's treated as a company, as a commercial entity. You can offset your costs, you can benefit from amortisation, you can benefit from VAT deduction. So that changes the situation in that particular investment. Another way of looking at it is landlord regulation. Now, for those of you that already own properties in the UK, you might groan every time you see the next latest set of regulations that come out, whether that be deposit regulation, deposit protection, carbon monoxide testing, even going down to Legionnaire's disease testing. There are an awful lot of regulations surrounding investment in the buy-to-let market in the UK. You may well be thinking, I've had enough of this UK regulation. There are other countries where regulation is slightly lower. Again, Poland does quite well in terms of the amount of regulation. You've got Germany's pretty good. Spain and France are a bit higher. If you're comparing more relatively to the UK. There are other things, like there's some rent control legislation in Germany and France, but that's in certain places and then quite specific rules. So there is a different scene there. We've talked about capital growth and yield. A bit difficult talking about capital growth without looking at specifics, but generally speaking, you can be looking at low to medium opportunities. If you're looking in cities and main towns, obviously if you're looking somewhere in a rural village, you're not going to get quite the same capital uplift. And yields are also fairly reasonable. The penultimate column, I haven't put in EU funder or recipient to be controversial in terms of Brexit. The funder is an F, a recipient is an R. The reason for putting that column in is because if a country is receiving, a net receiver of EU funds, generally speaking they're going into improving the infrastructure of that country. So for example in Poland, a lot of EU funds have gone into the country to improve the infrastructure in terms of the roads and the railways. And you'll know as a property investor that if you choose a property in the right location and it's also benefiting from infrastructure improvements, that has a positive effect in terms of uplifting the capital and value of that property. That's the reason why I put that in. And on a practical consideration, ease of getting a mortgage, that varies across each of the different countries. This has been, put this together from the purposes of a UK investor. So it's relatively easy to get a mortgage in the UK. You can argue how difficult it is, or it's getting more difficult with the prudential regulation, authority regulations coming in. But relatively speaking, France is still relatively good and relatively easy to get a mortgage in, and offering really keen rates at the minute. A bit more difficult in Germany and Poland and Spain to get mortgages, but it's another consideration when you're investing abroad. So hopefully that gives some food for thought about what opportunities there are in other countries and in other categories which attract a slightly beneficial taxation treatment. I think the important thing is to decide what your strategy is and what's important to you in investing, whether it's yield, capital growth, regulation, whatever it might be, and move forwards on that rather than letting tax dictate what your strategy is. It's something to take into consideration when you're thinking anyway. Just going to hand back over to Graham.